So I'll just turn it over now to Daryl Getter, who's going to be our moderator for this session.
Hello, everybody. Before I start, I was asked to give an announcement. After this session, everyone is invited to a happy hour at the Hamilton on 14th Street by the White House. So we're going to hurry up and get started here. So that, all right. The last session...
Actually, let me modify that slightly, which is that there is a final sort of brief logistical meeting. I would like to... Any scientific committee members, ARC members, or anybody that was sort of presenting or discussing a paper, I just want to sort of have a very brief meeting before we head over to the Hamilton. So come congregate down here and for some final logistics. Thanks.
Okay, so today's session, as you're well aware, there has been ability to repay requirements that lenders now must be aware of, so that we can ensure that borrowers have the ability to repay the loans that they get. This has been applied to mortgages and perhaps payday. However, I think it's fair to say that academics are still debating upon what are some of the key contributors to the inability to repay. So we have 3 papers today. We have one that talks about the people, one that talks about the products, and one that talks about the prices. So in terms of the people, are they creditworthy? Did we make loans to people that weren't as creditworthy? Is it maybe that wasn't as important as the fact that they had products that weren't that were tricky and full of traps or whatever? And then we have one that says, well, what about negative shocks? How important was the negative shocks? So without further ado, the first paper that we'll hear from today is by Mr. Stefan Hunt from the UK Financial Conduct Authority, and the paper is entitled The Impact of Access to Payday Loans on UK Customers, Borrowing Behavior and Credit Outcomes.
Thank you. So I'm going to talk about the impact of payday loans, and we're going to focus particularly on consumer credit and debt outcomes, though we'll talk a little bit broader than that as well. And this is a joint piece of work that I did with John Gathergood and Ben Gutman-Kenny, and Ben's also down in the audience here today as well. And it's a great pleasure to be here with my sort of sister organization in the US. So for those who don't know, the Financial Conduct Authority is essentially the UK's equivalent of the Consumer Financial Protection Bureau. And we find it increasingly useful to talk with the CFPB, and we hope that it's at least somewhat useful in the other direction. So I'm going to talk today about a piece of work that we did in the context of having to set a price cap on payday loans. This came from, actually direct from the UK's Parliament. We had about 1 week's notice. And they put into primary legislation a requirement to impose a price cap on high-cost short-term credit, which I'm going to refer to as payday loans, because it really is payday loans for the rest of this presentation. In order to think about how we were going to set this price cap, we obviously had to think about, well, what's going to be the impact on supply? I'm not actually going to cover that work today. That's all publicly available. But then we have to think about, as we're going to think about the effects that we're going to have on supply as we tighten up a price cap, obviously we need to think about the effects on consumers and what are the impacts on consumers. So there's 2 other questions that we focused on, and those are the focus of the presentation today, is what options are there for consumers when they no longer have access to payday loans? What do they do? And are these consumers better or worse off from not having payday loans? At least we want to try and get to that question as best as we could. As many of you will be aware of the literature that exists on payday lending, it's pretty much all the sort of rigorous literature is focused on the US, and it uses a bunch of different methodologies, but most of it focuses on sort of geographic variation across the different states. in terms of regulation, and there's mixed findings on the effects of payday loans. But we have to think about applying it to the UK, and unfortunately in the UK there is no variation, there was no historical variation in terms of policy. So we have to think about how we're going to identify the impacts of payday loans. So it turns out that what we decided to do was use what John Campbell was referring to earlier as the sort of natural experiments from the policies of firms, and this was using regression discontinuity. So if we look on the left-hand side graph at the bottom, we can look at the credit score for the x-axis. We can look at the credit scores of firms. So it turns out in the UK, for all the major payday lenders, they have credit scorecards, but those credit scorecards are not known to the borrowers at all. This is not public information. And we can look at, if we look at the y-axis, you want to look at what might be the impact of a particular rule, a particular cutoff for a specific firm on whether people got loans anywhere in the whole of the market. This y-axis is not whether you get a loan from this particular firm, it's whether you get a loan anywhere in the whole market at all. Now you'll notice, of course, this the jump doesn't go from 0% to 100%. It's a fuzzy regression discontinuity design. And the reason is because, of course, if you're on the left-hand side, if you're below the credit score cutoff here, you might be able to go to other firms and get a loan from other firms. So there's some other mechanisms as well. On the right-hand side, albeit you may get past the credit scoring part of the loan approval process. Actually, loan approval processes normally have multi-stages, and sometimes there's stages after the credit scoring processes. For example, there might be fraud checks. Some people get turned down on the right-hand side, but overall, you can see that there may be a discontinuity as shown here on the left-hand side. So what we wanted to do was try and look for these discontinuities across a whole range of firms, and then try to see, could we see, when you look at for outcome variables, this is moving to the right-hand side, trying to see is, can we see any actual discontinuities? Can we see any jumps in outcome measures? And that's basically what we tried to do with this part of our work, looking at the payday loan price cap to look at the impacts of payday loans. So with this in mind, we luckily have very strong legal powers. So this is John Campbell was talking yesterday a lot about cheese and the Zava data. It turns out, especially when you're given something to do with, you have to do something very quickly from Parliament, you can pretty much ask for the data sets you want within some bounds. So we used our legal powers and we went to the top 37 lenders in the industry and said, can you give us the details of all the loans you made in 2012 and 2013? And we want the names and addresses and loan sizes for every single loan that you made. We don't have unique identifiers. We don't have social security numbers in the UK that we could use. So we get that. That gives us pretty much the whole market. And then we decide to, well, obviously we need to get some discontinuities, so we chose 11 lenders. Broadly, this was based on size. And for those, we got all of the applications, whether they've been denied or accepted. And then at the loan level, we also got details of the credit approval process and the credit scores that happened at the application level, obviously with denied applications as well. We also got, though this isn't relevant for today's work, we also got fully disaggregated revenues and costs at the loan level. And that was actually very important for trying to model the supply side, understanding the effect of a price cap. We then, because we have the names and addresses for the individuals and we can get unique identifiers, we can actually match the same individuals across all the 37 different firms, so we can track them across all the individuals. And we can then go to the, again using legal powers, we then went to one of the major credit reference agencies and asked for all of the credit bureau files for this whole population as well. So we matched that in as well. And then lastly, we commissioned a consumer survey of 2,000 people. Obviously, there's a lot you can't see in credit bureau files, and we tried to match that in as well. So I'll give a quick bit of background on the payday market in the UK. So it's quite concentrated. Top 3 firms, 72%. There's around 400 firms. Most of them, of course, are very small. It's mainly online, over 80% online in the 2012-2013 period. So that's quite different to the US. The prices, I think, are relatively similar, and it depends whether you, my understanding in the US was that you linearized when you went to try and go for short-term loans, and you looked at the effects annually, you just took a linear. If you exponentiate, which is certainly the European rules for APRs, you get to roughly 5,000% APR which is the typical cost. So there's about 1.3 million customers in 2013, and they had 6 loans per customer. The average loan size, which actually is relatively commensurate to the US, is at £260 for 17 days. This is an infographic from our comms department. From the top left, you can see that people tend to be a bit younger than the average in the UK, and they're a bit less wealthy, but actually maybe this was less extreme than I would have expected. And this here, we took all the various different loan approval processes that we could get working. So one firm may have had various loan approval processes. They change their processes over time. Sometimes if people come in with different sets of information, they may be different processes. So we took the 17 loan approval processes that we could get working, and we tried to see whether there were discontinuities. And effectively, we got 9 of the loan approval processes working. That was from 4 different firms, covering around 80% of the market. And as you can see, this is some examples of those 4 different processes, one taken from each of the major firms. And you can see that there's sharp discontinuity. So actually, the size of the discontinuity varies a little bit by each of the firm. Broadly, the density tests work quite well. There's one slight wrinkle on that, which I'm going to skip over for today. The density tests work pretty well. And this is the first set of outcome variables when we look at the number of personal loan applications. If you look at the bottom, you can look at the 4 different processes I've taken from the 9 that worked. You can see there's before applying for payday loans, we see very smooth, no discontinuity. So essentially that's the falsification test. If you look on the right, above and you look at top, you can see that there's actually discontinuities across all the 4 different ones. And actually the scale is slightly different on the y-axis. It turns out in this particular case, actually the actual estimated effect is quite similar for all 4 of these different processes. So in order not to have to show 4 different charts for every single outcome, and what we did in the paper, we took the beta coefficients that we just estimated for, I just showed you 4 of them, but you can imagine doing it for all 9 different processes. So we actually pool the beta coefficients, and we show pooled estimates for most of the coefficients. And as you can see, when you move down to the chart here, when we have a whole load of outcome variables on the left-hand side, and we look 0 to 6 months, and then 6 to 12 months after applying for the payday loan, and we've got the coefficients, then we've also put the means up here so you can get some sense of the scale of the effects. And what we find, and I'm going to go through 5 different classes of outcome variable quite quickly, I think, we can see that actually getting payday loans causes people to apply for more other types of credit. And that isn't just true immediately after the payday loan, but that's actually also true in a 6 to 12-month period afterwards. And that's particularly true for personal loans, you'll notice as well. So actually, use of payday loans leads to more use of other kinds of credit, or more applications for other kinds of credit. Let's take a look at the actual credit portfolio. So this is actually the holdings of other products. And the evidence is a bit mixed on this slide, less so with others. We can see actually the holdings of personal loans increases. It turns out that this mortgage result is spurious. You can see actually the falsification test doesn't work for mortgages, though it does for pretty much everything else. And so we see an overall increase in the holdings of products. So there's a bit of nuance here, which I'll maybe come back to later. If you look at credit balances, we tend to see that credit balances for non-payday products increase after people get payday loans. And this is particularly true with personal loans. There's a small decrease 6 to 12 months afterwards for credit cards. And then if we move to the next set of outcome variables, we can actually try and see whether we're looking at credit events. Now, credit events is mostly missing payments for products, but it could also be the use of what we call unarranged overdrafts. In the US, what you just call overdrafts. We have arranged overdrafts, you don't. And we can actually see when you look at credit events that we start to see missing payments in other products. So payday loans cause consumers to increase their unarranged overdraft use, what you would call just overdraft use, and borrowers begin to miss payments on the non-payday products 6 to 12 months after 60 months after applying for the payday loan, if we actually look at their worst account status, this is measured in months. Their worst account you're most behind in terms of number of months. You're half a month behind more in payments from having taken a payday loan out versus not having a payday loan out. So we see this increase in missing payments. Then if we move on to the next set of outcomes, this is delinquency and default, we actually see an increase in non-payday defaults, and especially if you do non-payday defaults as a percentage of total non-payday balances, that goes up. And then if we look at the bottom right, which is this is change in credit score over a one-year period around getting the payday loans, we see in general people were this whole set of people were in a period where their credit scores were getting worse, but those people who took out payday loans had an extra 20 points drop in their credit scores over this period. So there's a series of what appear to be sort of negative effects, especially when we're looking at sort of default delinquency and credit scores. Taking some of those key variables, we're going to try and look at time before and after people take out payday loans. I'm actually going to start with the bottom right, and we're going to look at the holdings of personal loan products. And as we can see, as people take out payday loans, they begin to hold more personal loan products over time. One might imagine what kind of channels there are, but certainly my immediate thought as to this is people have taken out payday loans. They're pretty expensive. They've got to pay them back. They're looking for somewhere else to go to get loans to pay them back. If we then move actually now to the top left, which is overdraft usage, we can see in the actual month that people take out payday loans, there's a small decrease in overdraft usage. You can see the small decrease. It's about a 1% drop in overdraft usage, and that's off a base of about 11%. So it's a very small decrease in overdraft usage. But by 3 months after taking out payday loans, there's about a 4% increase in overdraft usage, and that's persistent, stays fully up to right up to 12 months after taking out payday loans. So looking at a couple of other variables, this is the non-payday default balances as a percentage of non-payday balances. Default here is defined as six or more months behind in payments, so it's not surprising there's a lag on this one. But as you can see, towards the end of the year, there's a very marked increase in the percentage of balances that are in default. And this worsening credit events means getting more months behind in payments, and as again we can see that this happens after taking out payday loans. Now, so that's the evidence that's the credit bureau evidence, which we've then matched into that. We've done a consumer survey of 2,000 people. We had to do a couple of focuses on a small part of the sample had to be used for particular problems that we were looking at for various reasons. So we took the remainder of the sample, about 1,600 people, and we put it evenly across three different buckets. Those people who were just below the credit score, those people are just above the credit score, and then the third group was tried to be relatively representative of everyone else. So we're going to focus, we focused most of our analysis on comparing groups 1 and 2, and I'm just going to give some flavour of the results here today. So we wanted to understand, of course, who people were. So this was information we couldn't get from the firms or from the credit bureau. So we tried to get a whole bunch of extra sort of demographics and financial capability measures from individuals. We then obviously wanted to understand what substitutes people would use. There's a whole load of informal measures that people might do. Of course, they might turn to illegal lending. They might borrow from friends and family. So we want to measure that. We also want to think about some formal substitutes. So not all formal substitutes will be captured by the credit reference agency data. In particular, certain types of overdraft usage, arranged overdraft usage, isn't covered in the credit bureau files. So we asked questions on that. And then we also tried to understand if people are trying to use their savings, reducing consumption. And then lastly, of course, we wanted to understand whether people are better or worse off. So we had a bank of metrics, subjective well-being metrics, a whole bunch of questions for financial distress. Then, of course, we asked about things like regret, and then some things about reasons for borrowing and how this money is used. So there's a telephone survey, and we had a relatively low response rate. As you can see, it's about 5% response rate. much to my surprise, actually, when you look at the population, you compare this population, this 5% sample, actually they look really, really similar on the observable characteristics, which I was surprised by. And actually, groups 1 and 2 are pretty similar. And now, this is actually not comparing groups 1 and 2, but comparing the marginally successful to the marginally unsuccessful individuals, those people who did get loans to didn't. So it's not quite a discontinuity comparison. But what we can see here is that we're comparing hypothetical, what people said they actually did when they didn't get payday loans to what people said they would have done if they wouldn't have got the payday loan. And to my surprise, actually, the hypothetical and the real outcomes are, seem to be very aligned. So people seem to be able to predict what they'd do quite well. So I'm not going to go more into some of the fancier stuff we did, and just say what immediately strikes out is most people just go without. The second biggest thing that people do is they borrow from friends and family. As I mentioned, we had questions on whether they would use illegal lending, and we actually designed questions with the illegal money lending team in the UK, and we found absolutely no effect of payday loan usage on usage of illegal lending, or lack of payday loan usage on use of illegal lending. So I'm going to skip quickly to the conclusion. So what we found in terms of payday loan usage, payday loans do provide some short-term liquidity. On loan denial, there's almost no short-run substitution to other formal borrowing, though there's a small increase in unarranged overdraft usage. People borrow more from friends and family. That's one thing that happens, but there's no evidence for substitution to illegal lending. Most just adjust to loan denial by foregoing or delaying consumption. That's the main thing. Payday loans cause a subsequent increase in non-payday credit products. In particular, what we found was most marked was this increase in overdraft usage that I showed earlier. Borrowers get further behind in payments on non-payday products, and their non-payday default debt balances increase, and the credit bureau scores decrease. That said, we didn't find any evidence of an effect on subjective well-being or financial distress. And I guess the last thing to add is this is the cap we came up with. This is obviously building in the supply-side model. This is about a 40-45% reduction in the amount that people were charging. So they could charge up to 0.8% per day for loans, and including rollovers and all aspects of various types of fees. The most that could ever be paid back was twice the amount that was borrowed, which I appreciate is still quite high, but it turns out the main thing that we had to consider in comparison to this was mass exit of all the firms in the market. So this is what we came up with.
Okay, thank you very much. Our next paper is by Felipe Severino from Dartmouth College, and the paper is entitled Changes in Buyer Composition and the Expansion of Credit During the Boom.
Hi. Thanks, everyone, and the organizers for inviting us to present this paper here. The name is Changes in Buyer Composition and the Expansion of Credit During the Boom. It's co-authored with Manuela Delino from Duke and Antoinette Schwartz from MIT. So, and before I start the paper or the presentation, I want to make sure that, or warn you in a way that what I'm going to do today is try to re-look some stylized fact with respect to the mortgage crisis with the aim to challenge what we know about the mortgage crisis. And to do that, we're going to have to basically depart from this approach of like causal inference and just like look at these patterns and see what can we learn from it and how do we make sense of it, okay? So with that in mind, the main motivation of this paper is this common view that during the mortgage crisis, innovation in the supply of credit led to a distortion on the allocation of credit throughout the income distribution. In particular, allocating more credit to poor households. This distortion in the allocation of credit led to increase in house prices, and then when the credit was cut, basically house prices dropped. And the main evidence of this credit supply income distortions rely on a negative correlation between income growth and mortgage growth that was stated in Mian and Sufi QJ paper in 2009. And in order to make sense of this stylized patterns that we're going to show you today, we're going to have to try to challenge those findings. All right? So what do we find? The first thing that we find, and the first thing that I want you to remember, is that credit expanded throughout the income distribution, and not just for the poor. So middle income and high income households had a much larger fraction of the total amount of mortgage origination, and the amount of mortgage that was allocated to poor households was small and stayed small throughout the whole boom, okay? So and then maybe super clear here we're not saying that there wasn't an expansion of credit, we're just saying that the way that credit was allocated throughout the income distribution was in line with what we would call a fundamentals story. So the second and very important point is that we find that the majority of credit in default, when we focus on the dollar values of default during the crisis, is coming from middle income households and zip codes and high FICO score borrowers, even when you look at within subprime areas, okay? And this fact is consistent with a view that the recent participation in the mortgage market implies a large fraction of households close to their maximum debt capacity when house prices drop. And I'm going to argue by the end that this has very specific implications in terms of what we think is the right regulation to prevent things like the mortgage crisis that we experience. And finally, and this is in order to make sense of all these findings with respect to previous literature, we're going to take a focus on households and not zip codes. And the main idea here is that households are the ones that take out mortgages, not zip codes. And why is that important? Because previous results focus on the total amount of mortgage in a zip code. And that measure is a composition of two things: the average mortgage size and the number of mortgages that your people in that zip code are taking. It turns out that when you look at those two things separately, independent on how you measure income, you find that the individual mortgage size is always positively correlated with income, and this negative correlation is only coming from the number of mortgages, so from the extensive margin. And even more important, actually, this negative correlation is coming from the high end of the income distribution. So it's basically telling you that places where you experience, so high income areas that experience a higher increase in income growth than the increase in mortgage are the ones that are driving that negative correlation. So overall, this tells you that there's no evidence that during the boom, there was a distortion on the allocation of credit. Okay, so that's a preview of the results. So now I'm gonna walk you through the patterns that I told you about. And in order to do this, we basically use mostly publicly available information data to look at the patterns of mortgage origination with respect to the income distribution. So we're gonna use HOMDA data, which we have already seen many papers using it already, so I don't think that I have to explain you too much about it, but you basically have the universe of mortgage that were originated in each year. And you have the balance, so the total amount of mortgage that was taken, and also you have the self-reported income that people use when they apply for that loan. We're gonna supplement that with IRS income data at the zip code level, house prices at the zip code level also from CILO, demographics from census, and then because we want to look at ex-post outcomes such as delinquency, we're gonna use LPS data, a 5% sample of the total population. And today I'm gonna focus on LPS data, but we have been basically finding the same patterns using black box data or the agency loan performance data that is publicly available. So the facts that I'm going to show you with respect to delinquency are robust to many different data sources. Before we go into the results, I'm not going to show you a related literature because of the time, and also because there's a vast literature trying to approach and trying to study what was the consequences of the way that credit was expanded during the crisis, all right? And we're basically, this study is trying to challenge a lot of those views, all right? So the first patterns, what do we see here? What we see here is for each year, we're gonna take the total amount of mortgages that were originated in that year, and then using the self-reported income, assign that specific mortgage to an income bucket. And we're gonna divide the whole amount of mortgage origination in 5 buckets, all right? And then we're gonna basically estimate the fraction of mortgage that was originated on that bucket with respect to the total amount of mortgage that you received and that it was originated in that year, all right? And we're gonna do the same for each year. So as you can see, each column sum up to 100. So this graph doesn't reflect the fact that the total amount of mortgage was growing through the boom, okay? It's just telling you about the distribution. And what you see here is that basically middle and high income areas, individuals in this case, are the ones that account for the biggest fraction of the total mortgage origination, and the allocation of mortgage on the low income was small, so 10%, and it stayed small during the whole boom, all right? So there could be concerns about the measure of income that we're using, so we're gonna repeat the same analysis, but now classifying mortgages based on a ranking using the IRS income per capita. It turns out that when you do that, you basically find similar patterns. Low-income guys have a slightly increase in the share, so it went from 10 to 12, but that's very far from arguing that there was a change in the way that credit was allocated. Okay? So the obvious follow-up question is, okay, this is focusing on first mortgage for purchase, so like mortgage origination for purchase, so what happened with other type of products? So what we're gonna do is we're gonna look at, through LPS, how the allocation of credit was distributed on second liens and cash-out refines, which arguably are the ones that could have led to a distortion on the allocation of credit. And here we basically have the same idea of pictures, but now also showing the magnitude of the amount of debt that each one of the projects have. So the first one is mortgage for purchase, the second one is second liens, and the third one is cash-out refis. And this is for a shot for a specific year, 2006, using, again, LPS data. But the bottom line is that you see that the way that the allocation of credit was distributed, it was according with income. So there wasn't really a distortion on it, okay? So basically 3 pictures are telling you that when you look at the data this way, you find that there's no evidence of a disallocation of credit. That, and let me be super clear here, that doesn't mean, we're not trying to argue that liar loans or like non-doc loans didn't exist. That's not the bottom line of these graphs. What we're trying to say is that those things, even if they exist, it didn't seem to matter in the way that the credit was allocated with respect to income. All right? Okay, so now let's move at the second point. What happened ex post? And here we're also gonna take a different approach to the data. So instead of focusing on the rates of default, we're gonna focus on the amount of dollars that went into default for mortgages that were originated in 2003, 4, 5, and 6. And here we're gonna be looking at whether those mortgages were delinquent 3 years onwards on the future. And we're gonna basically look at the rates, the mortgages that are delinquency and multiply it by the amount of that mortgage and calculate the fraction. And when you do that, you observe that kind of the inter-range, so the middle quintiles, are the ones that account for the highest fraction of delinquent mortgage. And that stays stable again through mortgages that were originated through the boom. So again, this is consistent with previous literature that have shown that the rates of default went up, but acknowledging that like basically a lot of mortgages defaulting on the lower end have a smaller impact because the amount of those mortgages are small. All right? And if you want to think about what are the consequences of this like credit expansion with respect to the global economy, we want to argue that this is the right measure, because this is the one that is going to impact financial intermediaries and at the end, the local economies. All right? So moving forward, we're also going to try to investigate what happened when you look at FICO score at the individual level. And here we also are finding somehow of contradicted patterns. We're finding, so here we're going to basically look what is the fraction of mortgages that are in default in terms of dollar value, and then classify them on 3 buckets. Subprime borrowers on white, the light gray is prime borrowers with a FICO between 620 and 660 and 720, and then like super prime borrowers with FICO scores about 720. When you do that, you see that for mortgages that were originated in 2003, subprimes are a big fraction. But as you move through mortgages that were originated by the end of the boom, the big fraction is coming from what we call prime borrowers, or high FICO scores guys. If you put this together with the fact that the amount of mortgage that was originated by the end of the boom was a lot bigger than at the beginning, the impact of high FICO borrowers in terms of default is a lot bigger than the impact of subprime borrowers. So how can we make this consistent with that some very, very convincing patterns that show that the fraction of subprime borrowers in a zip code is very positively correlated with mortgage origination, house prices, and exposed default? The answer to that is look at individual data. So what are we going to do? We're basically going to classify zip codes based on the fraction of subprime borrowers that a zip code has, which is highly correlated with the fraction of subprime borrowers that the zip code has, and then look at within those zip codes, prime and subprime zip codes, who are the individuals guys that are defaulting, and what is the contribution of those individuals guys to default. So when you do that, you see that specifically in 2006, it's true that defaults went up a lot more in subprime zip codes, but the fraction or the contribution of those defaults is coming from high FICO score guys. So again, by looking at the individual level data, we're finding that the ones that are the individuals that are contributing the most to the exposed defaults are the high FICO score guys. All right? So that solves like the puzzle with respect to like subprime and FICO scores. So what happened with credit and income? And for this, it's very important to kind of like go back to the specification that showed that negative correlation. What that specification does is like look at the growth on mortgage at the zip code level as a left-hand side variable, on the growth on income per capita as a right-hand side variable, and adding county fixed effects to control for like unobservable county characteristics. And what we're going to argue here in this paper is that this specification masks 2 things. One, as I already told you, on the left-hand side variable, you are masking, you are basically abstracting from the fact that individuals are the guys that take on mortgages, and therefore you need to take an individual approach to this analysis. And by doing that, you need to decompose the total amount of mortgage in a zip code in the average size and the number of loans, and that's what I'm going to focus in the next slide. But then there's another important issue too, is that the fact that income per capita in a zip code is the income of the residents, but not the income of the guys that are buying houses, and that is historically very different. But again, we don't need that, and it's not going to be the focus here. To come back to the first point, the first column shows the negative correlation that I was telling you about before. When you look at IRS income growth on total amount of zip codes growth, you find that negative coefficient. When you break out the left-hand side variable, you see that it's always positive when you look at the average mortgage size. All right? And again, the negative correlation is coming from there. So just to conclude, basically, this stylized fact and this revisiting of the data provide a novel explanation of the observed credit expansion due to a systemic wide increase on leverage throughout the income distribution, and not just for the poor. And this is consistent with home buyers and lenders buying into a housing bubble and then experiences the consequences as house prices drop. The fact that we see defaults coming from middle income areas and high FICO score is consistent with this view that the recent market participation led to a higher fraction of households close to their maximum debt capacity. And then when house prices drop, they basically didn't have any financial slack to react. And this fact highlights the need to think about macroprudential regulation that has to account for the fact that the total amount of leverage in the economy is going up, and that will not be solved using micro financial regulation or financial regulation for institutions. Thanks a lot. Appreciate it.
Okay, thank you very much. Our next speaker is Christopher Palmer from the University of California, Berkeley. And his paper is titled, "Why Did So Many Subprime Borrowers Default During the Crisis? Was it loose credit or plummeting prices?" Thank you.
Thank you. It's been a very successful conference, and yet I have to offer one suggestion from my 5-year-old. I was dropping him off at kindergarten on my way to the airport to come here, and he shouted back at the car as he ran off to the kindergarten playground, "Good luck at the carnival." So I'm imagining maybe next year we could have it say CFPB Research Carnival, and it was plenty successful on the enrollment and registration, but think what it could be if it was the carnival. So this is another paper in a series of papers that we've seen that are doing forensics on the housing crisis, and I'm focusing particularly on subprime borrowers. As motivation, it was really ground zero for a lot of the housing crisis. Subprime foreclosures accounted for more than half of the foreclosures that happened during the recession. And the big question is, why was there this surge in the subprime foreclosure rate? Why were so many subprime borrowers entering into foreclosure? There are lots of explanations for this. I want to focus on two very divergent stories. I'll show you evidence of these stories being advocated as somewhat of an either-or explanation for the crisis. One was that there was a change in the composition of borrowers. And if I think about why is there a surge in the subprime foreclosure rate, it's because something changed about subprime lending. Something changed about who the borrowers were and the products they were taking out. The second story is that something changed with economic conditions, and this affected subprime borrowers. So whether this is negative equity, whether this is unemployment, etc. So both of these are reasonable, and I'll show you that there's evidence that both of them are true. Disentangling them is important for policy, and I'm going to provide a method of being able to quantify their respective roles. So it helps me to pay attention in a talk if I have some sense of what's coming in what order, and I know where to expect what I'm most interested in. So I'll flesh these two stories out a little bit more, and then I'll show you the data and what it says about how subprime borrowers and subprime mortgage products are changing. I'll briefly describe why a hazard model is the right way to do this here and what the hazard model specification looks like, walk through some coefficients, put some numbers on this. I'll mention, especially, I want to spend some time talking about how to disentangle the role of prices and lending standards. If you've ever gotten into a discussion about this, as I had with my taxi driver a couple days ago here in DC, it's hard to argue that prices have an important role to play as distinct from lending standards, given that we think that prices themselves, and as the following paper after mine will show, prices themselves are in large part affected by lending standards and by credit conditions. So I'll mention how I go about disentangling the two, and then I'll conclude with kind of takeaway points and policy implications. So here's Krugman arguing for my first story, talking about a graph that I'll show you in a moment, writing in the New York Times saying many borrowers are ill-equipped to make judgments about these exotic loans, and he singles out teaser rates, prepayment penalties, et cetera, and maybe this is going to help motivate our financial regulation and help our financial regulation have sufficient teeth in the future. Here's Stan Leibowitz offering the counterpoint in the Wall Street Journal, so it works out well to have New York Times and Wall Street Journal opposite, saying many policy makers, ordinary people, New York Times columnists blame the rise of foreclosures squarely on the subprime mortgage lenders who misled borrowers. What was really behind this? It was negative equity, and the divergence in policy implications is enormous. So what is this divergence in policy implications? Let me just mention that briefly. Take story number one, lending standards fell, and what changed was a decline in borrower creditworthiness and them taking out risky products. Well, in that case, we want to restrict the contract space. We want to be able to say, well, the following risky products should be outlawed, and we've done much of that. It's very hard to find people offering subprime type mortgages with various risky features these days. So that's, I would call, a microprudential approach. Let's change the characteristics of mortgage products. The second, if it's a decline in property values and that's impeding distressed sales, well, that motivates more macroprudential policies. More, let's keep the credit market cooler throughout the entire boom. That might help prices from falling in the future, and it also might help there be an explosion of people who are at their max debt capacity, as Felipe just talked about. So there's this important distinction here. This has not only for this ex-ante micro versus macro pru, but also for ex-post remediation, how you think about what needs to happen to modify, for example, distressed mortgages, for stress testing as well to understand, and risk management, whether that's the government or a private organization trying to understand the riskiness of a given portfolio, the results of understanding how much loads on one and how much loads on two of the riskiness of a given mortgage portfolio informs all of those decisions. So I'm going to take an approach and try to bring some order to it that lots of people have taken, congressional reports, journalists, academic papers, of looking and comparing vintages or cohorts of subprime borrowers. So Felipe was just doing this where he was showing each bar was a vintage or a cohort of borrowers, and I'm going to do the same thing. And the question is this indicative of the cause in defaults? So here's this graph, my replication of it, that has motivated a lot of this literature. This is showing the cumulative default probability of the 2003 cohort. So on the x-axis, number of months since origination. On the y-axis, the total fraction of the 2003 cohort that is defaulted within a given period of time. So if I go out to, say, 24 months, around 5% of that 2003 cohort has defaulted. This line shows me the trajectory of the performance of borrowers who took out subprime mortgages in 2003. If I put 2004 on this, it looks largely similar, but let me point out that if you go about 5 years out, and you go up, a seemingly higher fraction of the 2004 cohort has defaulted than will seemingly ever default from the 2003 cohort. So there seems to be something different about the performance of the 2004 cohort. If I do the strip tease, go 2005, 2006, and 2007, largely monotonic decrease in the performance of subprime borrowers over time. So looking at this graph, you can see scope for both explanations. You could say, well, what happened here is a change in who these borrowers were. 2006, 2007 borrowers, they're just riskier. Banks are becoming more brazen. People are becoming more and more extrapolative in their house price beliefs. And what's happening here is a change in who these borrowers are and what their mortgages look like. On the other hand, you could say, no, it doesn't have anything to do with who these borrowers are. It's a change in what happened to them. So later cohorts are buying at the peak, they're underwater almost instantly. So you can see scope for both of these stories, and it just becomes an exercise really in what your prior is and how you read these tea leaves. So as I mentioned, it could come from both of these. It's not an either or. I'm going to tell you how much of it is both. And again, the empirical challenge here is how do you identify the importance of lending standards in a world where there's a fall in property values, which was potentially caused by that very change in lending standards. So one more graph just showing you aggregate what's happening differentially to these cohorts. This is the combined loan-to-value ratio of each of these cohorts, mark to market. So using an updated property valuation of their property for the denominator in that combined loan-to-value ratio. So the first thing I want to point your attention to is the numbers. This is each point at the beginning of a line is the combined loan-to-value ratio of a cohort at origination. So at the kind of the first month of that year, those first borrowers that are taking that out. So using the assessed valuation model denominator, you can see it seems like down payments are getting smaller, leverage is increasing over time. Perhaps this is evidence of these underwriting standards declining. The other pattern you see is that these early cohort borrowers, what's happening to their leverage? It's decreasing very rapidly. Why is that happening? It's not so much that they're paying down their mortgages during the first few years. It's that they're experiencing double-digit price appreciation in much of the country, 2003, 2004. So they have a large equity cushion that insulates them from the price declines, whereas these late cohort borrowers, 2006, 2007, they're underwater almost immediately after they take out their mortgage. They're buying at the peak. Prices are falling quite quickly. So turning to the data, this is the CoreLogic loan performance data from mortgage-backed securities, and it contains rich origination characteristics and then also follows the performance of these borrowers over time. So let me show you what these look like. Here are subprime borrower characteristics. Their FICO scores are low. Their debt-to-income ratios are high. All of these factors are indicative of some level of riskiness of this cohort, of this segment of the market, and yet they're not changing very much over time. What is changing a lot over time are these product characteristics, particularly the ones I'm highlighting at the end. So the share of these mortgages that have an interest-only time period or have a balloon component where there's a balloon payment that's due or have a second lien attached to them, that's changing quite dramatically over time. So that's what the data says about borrowers and products changing. Now, just because those individual characteristics such as the FICO scores are changing doesn't mean that the people aren't changing. Surely the people that take out interest-only mortgages are different than people who don't take out interest-only mortgages. So borrowers are changing as measured especially by the types of products that they're taking out. So I'm going to build a hazard model to analyze this data. Why is a hazard model the right way to think about this? Well, first of all, I'm thinking about default. That's a failure. But think about the structure of my data. I can see an individual in my data if and only if they have not yet defaulted. And as soon as they default, I see that they defaulted and then they're gone. So I have a sample selection issue, and if you remember from your math stats courses what a hazard is, it's the probability of failure given that I have not yet defaulted. So that works out very well. It's exactly the structure of my data. I have a proportional hazards model, so this lambda naught function is going to be the baseline hazard, which is scaled up and down by this linear index x beta. So how do I fill x beta? So it's x I CGT. I is an individual loan, so I have those borrower characteristics and those loan characteristics. Those are static, measured at time of origination. And then C is the cohort that you're in. So gamma C, this is a cohort main effect. And this is going to tell me how different, depending on what I'm controlling for, are these different cohorts. A measure of the change in prices that they're experiencing, and then geographic fixed effects. So thinking about what these gamma C's are, here's just a plot where I'm not controlling for anything else, just the baseline hazard and gamma C. So this is just a one-number measure of how different was the performance of each of these cohorts relative to 2003. So let me back up for a moment and remind you very high level what we're trying to do. Where did the rise in subprime defaults come from? It seems like a lot of them came from these later cohorts. This exercise that I'm going to walk you through right here is going to decompose where that rise in, where the deterioration in cohort performance came from. So you can see each cohort is performing much worse than the 2003 cohort. That's the omitted category. So each of these are positive and they're large, and all this is doing is running those first few graphs through this hazard model. As I introduce controls, it's going to say how different would these cohorts have performed if, for example, this next bar is when I add in geographic fixed effects. So maybe one of the reasons later cohorts perform poorly is that they are coming disproportionately from risky areas. We can control for geographic fixed effects and verify that there's nothing to do with geography that's causing all of this. So we can rule that out. We can put in borrower characteristics, and now what we're saying is, how different would cohorts have performed if they had all been in the same place and all had the same borrower observables? And the answer is they would have still been very different. We put in loan characteristics and we start to see some action. So now what this is saying is, if instead of being as different as they were, all borrowers took out identical mortgage products in each cohort, they would have defaulted 30%, there would have been 30% less heterogeneity across cohorts. So 30% of the difference across cohorts, the rise in defaults, would be explained by loan characteristics. So each of these bars tells me if I match on certain things, then how different would cohorts have been. I can put in borrower and loan characteristics to start to get a feel for this. I'm going to do the same exercise with prices. I have a Case-Shiller style repeat price index from CoreLogic. And so here's the punchline there. Prices are even more important than loan characteristics. They're explaining over 50% of the variation across cohorts here. And so what I'm saying here, and let me skip to this full model where you can see that the cohort differences are largely insignificant, is that if all cohorts had faced the same prices and the same loan and borrower characteristics, they would have been largely the same, which means this model is explaining where the rise in subprime defaults comes from, and it's doing this decomposition exercise for me. So before I put numbers on that, let me briefly mention that, again, there's this problem that if I want to say, well, this fraction of the variation comes from prices, this fraction of the variation comes from lending standards. If prices were caused by lending standards, it's hard to disentangle these. I'm not going to walk through the entire IV strategy and the control function approach that's in the paper, but what I do is I map historical cycles, price cycles in each geography onto current cycles. So arguably the things that happen that cause a city's boom and bust in the 1980s were unrelated to future changes in subprime lending in these areas. And the fascinating thing, which was highlighted a little bit by papers this week, has shown that there's some persistence here. So let me show you, this is an example just showing that there are lots of cities that have both booms and busts in both periods. But to just zoom in and pick two cities, here's Philadelphia and Pittsburgh. Philadelphia, blue line, repeat sales index, has a boom and a bust, both around late 80s, early 90s, and in the 2000s. Pittsburgh just kind of motors on both periods. So this is a complier for my instrument, if you will. These are places that have, if you scaled up what house price cycle they had in the late 80s, early 90s, you'd have a decent guess of the house price cycle that they have in the 2000s, in the sense that there's a strong first stage. So control function estimation, I can put in the residuals, basically is how this works, or flexible functions of them, and verify that, in fact, this graph looks very similar to the one you saw before. The model does a great job at explaining why there's variation across cohorts, why there was a deterioration in cohort performance, and thus where subprime defaults came from. And the numbers to put on this are that loan characteristics and the advent of riskier products and the change in borrowers and mortgage products is causing 30% of the rise in defaults. Loan price changes, price declines, especially later cohorts buying at the peak and facing strong price declines right away, is explaining 60% of that variation. The model combined is explaining 95% of that story. So let me walk through, in Chris's opening remarks, he was talking about the desire to get some kind of deep parameters that are more useful for policy. So using this model, I can then go back and tinker with the world and say, well, what if policy had been different? What if characteristics had been different? Or what if observed macroeconomic shocks had been different? How different would the performance of various cohorts have been? So let me orient you. I'm going to talk about the 2003 and the 2006 cohorts. Remember, 2003, very rosy cohort, actually defaulted on average 4% and change a year, whereas the 2006 cohort defaulted at 12% a year. So what kind of policy things would have to change, or what would have to change about the environment that these borrowers faced for that gap to be closed? So here's a table where I walk through some of those scenarios, and in particular, let me highlight what happens. So clearly, if they face each other's prices, the gap changes a lot. If I go here to this fourth column, what if they had both faced flat prices? Well, the 2003 cohort would have surely defaulted more than they did. The 2006 cohort, they would have happily taken flat prices relative to what they experienced. And there's still a gap there, and you can see from the final column that that gap is closed completely if they had had similar characteristics. So that's just telling you basically the same thing as the results that I showed you before. But what I want to highlight here is that even if you thought from those first graphs, what we really need to do is return to the good old days lending environment of 2003. It's not so much that those 2003 borrowers with their lending environment were bulletproof. They also would have been severely affected by a downturn which was orthogonal to their credit standards. Okay, so if they had just faced a macroeconomic shock, they also would have had a tremendous increase in default. So this kind of gives us a bound on what we could hope to achieve in that sense. So thinking about the policy implications here, I mentioned at the beginning I wanted to draw this contrast between microprudential and macroprudential and what the right balance here is. So again, if our entire focus is on microprudential, which incidentally is quite justified by my results, showing that much of the increase in subprime defaults came from these risky product types, then certainly that is going to make a difference, as the simulations show. However, it could, to Felipe's point, it could push the burden of financial regulation in the incidence of closing off this credit market on a particular group of borrowers who were not responsible for the lion's share of the defaults. On the other hand, macroprudential policy, provided that macroprudential policy has enough efficacy to be able to rein in credit and have a smoother price cycle, which I think is open for future research, seems to have some scope here as well, given that 60% of this was caused by the macroeconomic fluctuation as embodied by local price changes. So are price declines relevant only for risky borrowers? No, everyone's impacted. You need both of these strategies to be working in concert. So wrapping up, my goal here was to speak to the debate about the causes of the overall subprime crisis. I offered a new strategy for disentangling these effects. The numbers you can take home and put under your pillow are that 30% of the lending standards, 30% of this decline in cohort performance, 30% of the rash increase in subprime defaults came from lending standards, 60% of it came from prices. Very little of it came from things that are not captured by those two factors. Mortgage regulation, just doing this kind of, well, we're going to tweak the mortgage contract space is not going to be enough. It could go too far. There's need for this kind of shared sacrifice through macroprudential policy, and there are broad implications here that hopefully several of you found interesting. Thank you.
Okay. Our last paper is by Marco DiMaggio from Columbia University, entitled Credit-Induced Boom and Bust.
Okay, so thanks a lot to the organizer for including our paper. This is joint work with Amir Kermani, who is here. So let me start with some general motivation. The idea is that the Great Recession was preceded by a large expansion of credit, and most importantly was followed by a collapse in house prices, employment, consumption, and a spike in delinquency. Just to give you some numbers, if you look at, for example, the flow of funds, mortgage liabilities increased by almost $6 trillion during 2006. If you look at employment, employment declined and peaked at 10% in October 2009. Moreover, there is also some important regional differences. In particular, exactly the regions that experience the larger increase in credit availability are also the ones that experience the more severe boom and bust in house prices, employment, consumption. Just to give you a sense, these are the left panel, the up panel there, are mortgage liabilities for households in the US. And then you have house prices, employment, and delinquency rates. As you can see, basically exactly the same counties that experience the largest increase in credit during the boom years are also the ones that experience the largest boom and bust in house prices, employment. And then for delinquency rates, delinquency first went down because you were relaxing a credit constraint, and then this basically spiked during the bust. So what's our research question? The research question is how much of these fluctuations, how much of this boom and bust pattern in house prices and in general in real economic activity can be explained by an outward shift in the credit supply? And in particular, how much of this can be explained by an outward shift in credit supply towards riskier borrowers? So what is the identification challenge? The challenge is that if you observe these counties, you're going to see a correlation between all of these variables. In particular, counties that experience higher growth are also going to demand houses. House prices is going to go up. Consumption is going to go up. And they are also going to have higher demand for credit. So in the end, we are also only going to explain, only going to observe a spurious correlation among all these variables. And credit is not really doing anything there. So what's our identification strategy? Our identification strategy uses an unnatural experiment, like John said before, and uses two main regulatory changes in the US. The first one was that starting in 1999, many different states adopted what are called anti-predatory laws. So I'm going to be a little bit more specific on what this really entails, but these anti-predatory laws basically were restricting the amount and the terms of lending towards riskier borrowers. But the most interesting thing is that in 2004, the OCC, the Office of Control of Currency, passed what's called a preemption rule. So this preemption rule only applied to national banks. So this is great variation for us, because now you're going to have states with anti-predatory laws, states without anti-predatory laws, and then you're going to have before and after this preemption rule. And within states that adopted the anti-predatory law, you're going to have more or less exposure to this preemption rule depending on the fraction or the importance of national banks within these counties. Okay? And this is, we're going to use exactly the passage of this preemption rule as a positive shock to the credit supply towards riskier borrowers. Because remember, these are anti-predatory laws. These are exactly for the high-cost mortgages in the US. So let me tell you in a nutshell what are the main results. First of all, we show a very important first stage. So if we compare counties with a high fraction national banks in states with anti-predatory laws compared to counties with a lower fraction national banks, then we see a 18% increase in the credit supply during the boom years, right after the preemption rule, after the OCC implemented the preemption rule. And this was followed by a similar bust in the credit supply during the 2007-2010 period. Then we use this as an instrument, and we say, okay, how much of the increase in house prices can actually be explained by an upward shift in credit supply? And we see that a 10% increase in the credit supply can explain, it leads to 3% increase in house prices growth, which compounded over the boom years is about 10 to 12%. Then we look at employment, especially employment in non-tradable sector, because our mechanism is going to work through the local demand. And we show that a 10% increase in the credit supply is going to increase employment by about 2%. And then delinquency rates first are going to collapse, and then are going to increase very significantly. In particular, we're going to look at almost a 30% increase during the bust. Also, another interesting thing that is going to provide some evidence of really the mechanism behind our effects are heterogeneous effects. So we're going to look at counties where we expect our effects to be stronger, in particular counties with a higher fraction of prime borrowers, fraction of more inelastic housing, or less affordable housing. And those are exactly the counties where all our effects are much stronger. And then I'm going to try to spend a couple of minutes just to convince you that this is indeed very robust results to a bunch of different alternative hypotheses. Okay? Now, let me just rephrase our contribution. Since there has been a lot going on in terms of the research and literature on this debate, our contribution is the following. If you think about all what's going on up to now, for example, Mian and Sufi type of papers, they had in the back of their mind a positive shock. This positive shock might come from a relaxation of lending standard, inflows from China, securitization, it doesn't really matter. And then they were using the elasticity as a static regional characteristics to measure how this shock propagates in the US. Our paper, in contrast, has a completely different approach. We say we are providing, hopefully, a credible instrument for an outward shift in the credit supply. So we have a direct mechanism, a direct measure of this outward shift in credit supply. And then we can control, and we can be sure to control for regional differences that might or might not be correlated with this credit supply. Now, let me go to the regulatory framework, even if here, basically, I should skip this slide. But one thing that we take advantage of is the fact that different type of lending institutions are regulated by different agencies. Okay, so from the OCC for national banks, OTS, HUD, the National Credit Union, and so on. The interesting thing is that in 1994, the federal regulator implemented a federal anti-predatory law. And these were trying to limit, for example, the high-cost mortgages, the interest rate, the prepayment penalties, the points, and so on, or the disclosure rules for these mortgages. The problem was that these only applied to less than 1% of the mortgage market. So starting in 1999, the first state was North Carolina, implemented these anti-predatory laws. And by 2007, almost 20 states, a little bit more than 20 states in the US implemented these anti-predatory laws that actually had the bite in the mortgage market. And why they bite, there is a bunch of papers that actually do event studies, and they show these anti-predatory laws have some effects. For example, after the implementation of these anti-predatory laws, there is a reduction in default rates, there is a reduction in the usage of complex mortgages, there is a reduction in prepayment penalties. There is also a paper by Keys and others on QJE that uses actually the passage of these anti-predatory laws also as an instrument for securitization. Why? Because credit rating agency didn't really want to rate securities that were using loans originating in states with anti-predatory laws because they were almost illegal. Okay? Then the most important thing that we need to thank basically the OCC for this is that in January 2004, they passed this preemption rule. And what they said was that specifically preempted all regulation pertaining the loan-to-value ratios, the terms of credit repayment, the aggregate amount of funds that can be lent secured by collateral, the access to the credit reports, disclosure advertising, the rates of interest on the mortgage loans. So everything about the credit market should have been regulated by the OCC and not by the state regulators. Okay, so we're going to use exactly the passage of this preemption rule as a positive shock to the credit supply from national banks. Just to give you some anecdotal evidence that this actually matter, I'm showing here a quote from New Century 10K in 2004. And the first quote basically reads that this would effectively, and it's referring to the anti-predatory law, this would effectively preclude us from continuing to originate loans that fit within the newly defined threshold. So they were actually worried about these laws. And then the other second important thing is that 2004 is actually the passage of this OCC preemption rule. And so they also say some of our competitors who are owned or are subsidiaries of national banks can actually lend to these borrowers. And so this might actually hurt us. Okay, so we're going to be negatively affected by this preemption rule. Now, the data, this is pretty standard. We put together HAMDA data because it gives us information on the originators of the different loans. So we can actually distinguish between a loan made by OCC-regulated bank versus OTS, HUD, and so on. And then we have also some information that we take, for example, from the literature on the anti-predatory law measures, or real estate prices, we get it from Zillow. Other measures or county-level measures, we can get it also from, for example, the New York Consumer Credit Panel. We get there, for example, the FICO score and the mortgage liabilities. Now, let's think about 1 second research design. So I basically told you that there are two main sources of variation. One is that across states over time, they adopted this anti-predatory law. So one first approach might be, well, let's just compare states that adopted these anti-predatory laws versus states that did not, okay? So for example, the HARROs that are here. So the problem is that the introduction of these laws are going to be endogenous because these are going to reflect conditions of the local mortgage market. So we don't want to do that. So a second approach might be, let's go a little bit more microdata. Let's look within the states and compare counties with the higher fraction of national banks in the pre-period versus counties with the low fraction national banks. The problem here is that we are going to compare different type of lending institutions. And for example, comparing national banks versus independent mortgage originators, their growth and their source of funding are going to be very different. Just because, for example, securitization has been much more important for independent mortgage lenders than for national banks. So we don't want to have this approach either. So what we do is basically a triple diff and diff. So we use all the variation there is there. So we're going to compare counties with a high fraction of national banks, counties with the low fraction national banks, across states and across time. So the identification assumption is going to be that this difference between the counties with the high and low fraction national banks does not differ across states. Okay? So I'm going to show you that, for example, the fraction of the counties with higher or lower fraction OCC might change, might have different characteristics. The important thing is that these different characteristics are not going to change across different states. So the first thing I want to show you is that indeed I can use the fraction of lending coming from OCC in the pre-period. What is my pre-period? We are going to define it as the fraction measured in 2003. So this is the fraction of all loans made by OCC lenders in 2003. And this is the correlation between the fraction in 2003 and 2005. And the two lines are for states with or without APL laws. Why I'm showing this? Because I want to show you that, first of all, these measures are very stable, and these don't change across different states. So we're going to use this measure for our main variation. Okay? Let me show you the main result. So basically, the main result can be seen also just by these summary statistics. So we look at summary statistics for loan amounts, house prices, and employment in states with and without. So the states without anti-predatory laws are the first two columns. The states with anti-predatory laws are the third and the fourth column. And then the fifth column is basically our estimator. So the difference between these different counties. We first look at the boom years. And as you can see, we can show that even just without controlling for anything, we show a positive effect for loan amounts, house prices, and employment, while the sign is exactly reversed during the bust years. And there is basically no evidence of pre-trend. So we look at the years before, and we show that there is no differential effects, differential trends across these different counties, across these different states. Now let's go a little bit more specific. And first of all, let me show you the first stage. So the first way in which we're going to show this is by looking at the loan amount, and the main coefficient is going to be the interaction between APL, which is 1 or 0, depending if the state has an anti-predatory law, post after the preemption rule. And here OCC is just an indicator that says if the loan is coming from an OCC lender. What we show here is that even controlling for county times agency fixed effect, so we are absorbing a lot of variation here, or even looking at counties by year fixed effect, which should absorb any demand level variation, we show that counties with a higher fraction national banks there is a higher growth in lending. Okay? Here we show instead a similar results, but instead of looking at only loans made by OCC, let's look at the whole loan origination in these different counties. And the main variables is always going to be the tribal interaction between APL, post, and the fraction of OCC, controlling always for county and here fixed effect. And we find basically a positive and significant effect during the boom years. And it doesn't really matter if we control for population, income, the elasticity of housing supply. For example, our instrument is completely unrelated to the elasticity of housing supply. It does matter for loan origination, but it doesn't matter for our estimates. And the same also for the fraction of subprime borrowers in the pre-period. It doesn't really matter for us. Here basically is a graph that shows you exactly the same result, but over time, so the dynamics of this effect. As you can see, there is basically no effect during the pre-period, so in 2000, 2001, 2002, 2003, but then there is a boom and a bust. Okay? So these also reassure us that indeed we are not capturing any difference in the characteristics of these counties in the pre-period. Then the first thing that, let me skip the economic magnitude, but as I said, is about at least 11% increase after the preemption rule. Let me go to the first main variable, which is going to be house prices. So for house prices, we look at our main interaction, and we see that basically we've observed that in counties with a higher fraction national banks, after the passage of this preemption rule, house prices increased more. We can actually use an IV here, and that coefficient of 0.33 tells you that a 10% increase in loan origination increases house prices by 3.3% in yearly annual growth. Okay. And here is exactly the same graph that I was showing before. This is the dynamics, so you see no pre-trend before, and then you see an increase in house prices right after the preemption, and then a decline over time. So exactly the boom and bust pattern that I was talking about before. And below, the first two columns are for the boom years up to 2006, and then the third and the fourth column are from 2007 onward. And you see basically the negative effect. Controlling for elasticity, controlling for the fraction subprime, doesn't really matter. Employment is non-tradable. So is there any other effect in the real economy of this expansion of credit? We actually see, and let me go directly to the IV, there is see that a 10% increase in loan origination increase employment in non-tradable sector by 2.2%, okay? And the same pattern in terms of boom and bust. In terms of delinquency, what I was saying before when I showed you the graph at the beginning was that delinquency first go down and then spikes. So these tables is constructed by looking at the period 2000-2006, and here you see a negative effect. So exactly in the counties where national banks were lending like crazy to subprime or riskier borrowers, these were not defaulting up to 2006. And even by quite a lot, in the sense that this is a decline in delinquency rate by almost 30%. However, if you look then at the bust, then the third and the fourth column here show you that delinquency rate spikes and increase by almost 60%. So those counties where national banks were lending during the boom years also end up being more fragile because those are the ones that experience the higher default rates. Now, let me show you some heterogeneous effects because I think these are interesting and also these provide some evidence of our mechanism. And two that I plotted here are about subprime regions and inelastic regions. As you can see, all the boom and bust, once we interact for the subprime counties, so below 660, we see that both the boom and bust for loan amounts, house prices, employment, and delinquency are much stronger. And the same for inelastic counties. Okay, so this tells us the story probably is exactly what we are trying to push, that these national banks were lending to the low end of the distribution in terms of health of the borrowers, and these are exactly the countries where we experience the stronger boom and bust cycle. Now I want to mention in the last 1 second, I want to mention the different robustness checks. We do a bunch of different things. We can control for securitization activity, so we observe how many of these loans were securitized. It doesn't really matter for us. We look at state borders, so we can do a regression discontinuity across the borders. We can look at CRA lending. So all of these are going to show that is actually due to household debt and not firms' investment. We can look at different, if there is any regular arbitrage, we found no effect there. And we also show some loan level evidence that indeed those characteristics, for example, Chris was talking about, balloon payments, high cost, those are exactly the ones that get originated more by national banks after the preemption. Okay? Thank you so much.
Okay, awesome. Our next speaker is Jalon Wang from the Consumer Financial Protection Bureau. She'll be discussing the papers. Thank you.
Thank you so much. So thanks for everyone for attending our first CFPB research conference. I hope we've really shown you in the past couple of days, how much we go above and beyond, to really make this a great conference. And in particular, I think what distinguishes this conference from every other consumer finance conference, as you've seen, is that for the amusement and entertainment of the audience, we, the CFPB staff, have subjected ourselves to discussing 3 or 4 papers in 10 minutes. And we've seen a variety of approaches of coping mechanisms for how to do this. We started off, my colleague John Lanning, took the auctioneer speaking style approach, and I think he has a really promising career ahead of him if the CFPB thing doesn't work out as a cattle auctioneer or selling pork bellies or something like that. Dustin took the approach of self-deprecation, making fun of his ginormous and misshapen head. Today, we've seen various approaches, camels, hockey metaphors, and really beautiful and simplistic approach of just taking more than 10 minutes. It's awesome. I should have thought about that. Sadly, I didn't before coming up with these slides. So my not to disappoint anyone in the audience, my coping mechanism for this task is going to be equally futile, so I'm just going to move on ahead. So this, the session today is about credit supply, and inefficiencies in credit supply have implications, as we've seen, for both the macroeconomy and consumer protection. And of course, different sets of regulators, are tasked with these 2 different sets of goals, and safety and soundness and consumer protection. And the point I want to make is that these are distinct but also interrelated goals. And in particular, these 2 goals are impacted differently by changes in credit supply for secured versus unsecured credit markets. And we've seen papers in this session on both of those types of markets. So for the housing market, I think that these 2 goals, so the consumer welfare and also macroeconomic stability, are generally, we can think of those as aligned in terms of having exacerbated boom and bust cycles and housing prices also has negative impacts for consumers in terms of a lot of foreclosures, lots of externalities, consumer bankruptcies, et cetera. However, for unsecured credit markets, these interactions might be a little bit different, in that default might have fewer implications on both firms and consumers in the unsecured credit market. So one one fact that stays with me for a long time is that credit card issuers actually remained quite profitable, at least had positive profits, despite the depths of the Great Recession. And one potential reason for this is that they're able to get lots of fees and interest, and in particular, so the Agarwal et al. Paper that was mentioned early on today actually showed that it's the more subprime, the less creditworthy borrowers who are more profitable. So this makes it a little bit distinct from the impacts of default for secured credit markets like the mortgage market. And in particular, though, one thing, one potential concern in unsecured markets that does impact consumers and potentially the macroeconomy is about consumption, that excess supply of unsecured credit may lead to greater consumption volatility instead of consumption smoothing, which is one of the goals of having these instruments be available. So I'm going to first tackle the unsecured market. The first paper on the welfare effects of online payday loans in the UK by Stefan Hunt and colleagues. So I just want to take the opportunity to say, this is wonderful. Just absolutely brilliant work, and I think all the regulators in the room can really just, really appreciate how much hard work and courage it takes to carry out this type of ambitious research program in the confines of, kind of high stakes, very controversial rulemaking, with a lot of time pressure. I just absolutely just want to salute your efforts. And I think not only, doing this type of research, collecting this data, and doing survey, collecting primary data on top of administrative data, I think this really pushes forward the literature about this type of loan, in that this is the first paper, really the frontier in terms of having actual loan records. So a lot of the literature doesn't have actual payday loan borrowers and is using geographic variation, as well as most of the market. So we're capturing spillover effects across lenders and in combining both survey and credit bureau attributes. So just to say a few things, I think one thing that's really, really interesting is the complementarity between this type of high-cost loan and other forms of credit, which is something we didn't know before. And why do we see this complementarity? One plausible reason is that they have to take out other forms of credit in order to repay this payday loan. But I don't think from your study we really know ultimately why, and that's, I think, a really important question. Another question is, would any type of credit be bad for this type of consumer that is seeking this type of credit? Or is it something about the particular types of loans that are available in the market today? Is it something about the cost or the loan structure of these particular types of loans, or would these consumers simply be harmed by any type of credit? So now moving on to the futile portion of this presentation, in terms of kind of putting together the three remaining papers about the mortgage market, which I think really fall together nicely into different sides of a debate about what really happened in the financial crisis. And so, I'm going to go through, just to set up the debate, a brief history of the financial crisis in 1 minute. So, in the lead up, in the early to mid 2000s, what did we have? Low interest rates. So the famous 1% regime after the boom, the bust of the dot-com bubble. So we had low interest rates, also doubling of global imbalances during this time. So central banks were investing in treasury assets, which may have further depressed interest rates and led to a boom in housing construction. But also a lot of institutional investors, a lot of global capital was trying to flow into the US mortgage market. But US household creditworthiness was not really increasing during this period. So in fact, household income was slightly decreasing during the early 2000s. So there wasn't a growth in creditworthiness to absorb this large influx of credit supply. So, the story we tell ourselves, or a common narrative of what happened during the crisis, is that how can the U.S. households absorb this large pool of credit when their creditworthiness and income wasn't really increasing? The only way that could have happened is if underwriting standards were deteriorating. These deteriorating standards caused the boom and bust cycle, or contributed to the boom and bust cycle and housing prices, and also the increase in default rates that started in 2006 and then filtered out through the entire financial system through the magic of CDOs, and then led to the Great Recession. But is this narrative actually correct? And that's what three of our papers today really tried to answer. So Marco's paper, I think, generally consistent with this story, right? So we see each of these different variables. We see an instrument for credit expansion that did lead to origination growth and increases boom and bust cycle in housing prices, as well as a boom and bust in employment growth and delinquencies. The other two papers say no. So Chris's paper looks at defaults, doesn't look at the originations and other things, but what he finds is that most of the variation in mortgage defaults across cohorts was actually caused by changes in prices, and very, very little actually changes in borrower characteristics. So the final paper, Felipe's paper, also is on the side that it's actually the price increases that led to what we saw, and in fact, the income of home buyers was increasing relative to average residents in high price growth zip codes, and there wasn't an overall deterioration in lending standards. Just to kind of dig a little bit deeper in these three papers, what we have is for the DiMaggio and Kermani paper, I think it's a promising new instrument that really pushes forward sort of this literature investigating the role of credit supply. And I think as a researcher, as an empirical researcher, one of the sad facts that I've had to confront is that adding more diffs doesn't actually decrease the number of assumptions we need for identification, sadly. And I have to say, I actually completely believe their results, but the parallel trends assumption is really critical for any type of diff and diff or triple diff specification. And that, they do a really nice job. He showed the graphs where they're in the pre-period, we're really seeing no effect, and it really starts after 2004 when their instrument is active. But a lot of things were changing, more than the order of magnitude of 10% increase in credit supply. So I to be honest, I actually believe the result, but I think, maybe a little bit more micro-evidence, such as looking at the particular lenders who were OCC regulated. Did we see a discontinuous change within those individual lenders? But I have to say they do an extremely diligent job, putting together lots of data sets to analyze a lot of alternative hypotheses. So I also really love Chris's paper. I think it's an incredibly clever and well-executed paper and really, really clearly written. And I think it was shocking to me when I first saw your paper, how well this instrument actually works. And it's not driven by the things we would think, the subprime expansion, things like that we would, maybe normally expect to be driven by these price cycles. But I think one thing I would like a little bit more discussion on, especially given how well you discussed everything else in the paper, exactly where your identification comes from, is, what's the role of the aggregate versus cross-sectional price effects? So what, I think in your talk as well, you said, we use prices, changes in prices. But in fact, there's an important aggregate component as well as the cross-sectional component, which is where your instrument really comes in. So he's using a cross-sectional source of variation. But I think the loading on that is different for each time period in order to capture that boom and bust, which I think, sort of the boom and bust part of price changes is the same for across time. And I think the aggregate, going back to Bernanke and the global savings glut, I think the role of aggregate supply in potentially impacting prices is a really important factor. And maybe you could just explain a little bit more how your approach gets into that. And finally, Felipe's paper, I think really, and he was very clear that it's not a causal paper. I think they really show a lot of really important descriptive facts that we, really important to know about the relationship between income and loan origination. And, to be honest, I have to say, don't have time, of course, to discuss a lot of really interesting parts of these papers, in particular data. So I think Felipe and Marco use HMDA data, Chris uses CoreLogic, and, I would really encourage anyone who's interested in this to look at the Mian and Sufi. They have a response to Felipe's paper that really gets into the details of income measurement, which I'm just not going to be able to go over here. But I think, again, in terms of if we really want to put it as an either or, is it prices or is it supply? At least in the version I read, I think Felipe presented a slightly different conclusion this time that didn't emphasize kind of saying that price expectations were really the driver of mortgage growth. I think, in terms of the fact that we still see is that mortgage growth was driven by the extensive margin in these regions that ex post happen to have high price growth. So, there is still a lot of supply growth, and we did subsequently see, ex post a lot of price growth. So I think there could still be a role for supply there in terms of interpretation. So, I touched on this, with all of the papers in terms of what I think policy-wise, the elephant in the financial crisis post-mortem literature is about the role of the aggregate supply and aggregate price dynamics, which I totally understand, in papers why we would want to utilize cross-sectional variation for identification purposes, but I think for policy we really want to understand a little bit more the aggregate effects. So in summary, this session covered the effects of credit supply for both unsecured and secured credit markets. And we saw a really nice example of the negative effects of expansion of unsecured credit. And I think it's fair to say that the debate will continue about what exactly was the role of prices versus supply in the financial crisis in mortgages. Thanks.
Okay, I suspect there are New Yorkers in the audience thinking, boy, those CFPB discussants can really talk fast. How about we start off, we only have 10 minutes for happy hour, so why don't we give the panelists an opportunity to respond to our discussants' comments? And we can,
I'll go first. My mic is already live. Thanks for the really savvy comments. I think you touched on a couple themes that we can all take away. One is that at the end of the day, a lot of what we really care about is aggregate effects, and we end up shining the light on effects that we can identify with cross-sectional variation because that's what we can identify. And it's always nice to find a way to tie back to those aggregate effects. Personally, I think a lot of papers that are published even in top journals that identify off of cross-sectional variation and then try to do in the conclusion a back-of-the-envelope extrapolation to aggregate up to the aggregate effect probably get it wrong, and we're probably missing a lot of aggregate effects. So that really is the golden goose in empirical work, is to be able to identify some aggregate effects. I think a lot of us highlighted some of these. It would be really nice to know about the effect and incidence of the global savings glut, or the effect and incidence of macroprudential policy. A lot of policy operates at this national level, and it's hard to identify its effects. So those are all things that is definitely worth thinking about, and I'm glad to have had them highlighted. Thank you.
So just highlighting one thing of where we could go next with some of this payday work, and actually touching slightly upon what Darryl mentioned earlier as well, which is the ability to repay, what we call affordable lending. I think there's one potential to use this kind of analysis to look at the heterogeneous effects. So one thing we really didn't focus on here was how different types of individuals could be differentially affected. And I think we've got enough power here to try and use quite general methods to try and look at sort of maybe machine learning and these kind of things to try and look at exactly which kind of variables are related to differential effects, and then we can actually try and think of what would constitute good responsible lending rules, rather than just, as we've done historically, essentially give it over to firms to kind of think about what should be in a responsible lending rule. We could actually try to use this sort of analysis to kind of further that ourselves.
So let me first of all, thanks a lot for the great discussion. So let me say that, for example, we take, this is just our first step to this question, and this was the macro paper in terms of understanding what are the aggregate implications of a shift in the credit supply that comes from the regulation. And then we have a follow-up paper that actually looks at much more micro loan level evidence and points out exactly to some of the evidence that Chris was showing, that during the boom years, one thing that changed was the type of contracts. And we show that this type of deregulation affected exactly the type of contracts the national banks were offering to these riskier borrowers. So here, what I showed you was only the aggregate amount and the loan amounts for these households. But then when you go to the loan level, you actually can see how many of these feature exactly prepayment penalties, interest only, negative amortization, balloon payment. And if you look at places where, if you look at loans originated by national banks after this preemption, they will start originating 10 to 15% more of loans with exactly this type of characteristics. And then you can trace out, for example, default rates for these households matching on observables, and these are exactly the ones that default, that are much more likely to default exposed. So thanks again a lot, and this is, I think, just the first step for a much broader research agenda.
Okay, now, can you hear me? Okay. Thanks a lot for the discussion. It was great. I guess it was a great challenge to try to put together in 10 minutes a discussion for 4 papers. So I appreciate it. I just want to say 2 things to make extremely clear, how robust our results are. Basically, everything that I told you today, it doesn't rely on any measure of income. You can throw literally whatever measure of income you want, and the patterns that I show you, they will stand up. And the other thing is the extensive margin is not coming from low-income areas. It's coming from actually the high-income ones. So it's basically, if you want, almost the opposite interpretation that the original paper had. But having said that, I just want to leave you with a thought in a way. I think that we're trying to push this paper and this agenda just because we think that as a researchers, we got super comfortable with the narrative that we understood. And it was like basically highly, I don't know, exposed with respect to what happened during the crisis. And basically, like, just by looking at the data in a slightly different way, you get a very different view of it. And that puts a lot of pressure in trying to understand precisely what happens, because the implications going forward to try to address these type of things in the futures are very different. And that's why we want to, like, and that's what this basically attempt to challenge previous findings is trying to do. So thanks a lot again for like the opportunity to share that with you.
We'll go with the question over here, Chris Carroll.
Thanks. I wanted first to compliment Jelan on an amazing job, but to point out that she had the advantage of being the last discussant, and so she was able to combine all of the strategies of the prior discussants. The incredible swift speaking style and the modest self-deprecation and the taking a little bit of extra time. But that's probably the optimal strategy, to learn a little bit from everyone that came before. I loved this session. I loved all the sessions. The one thing that I think might be very valuable for all of these kinds of papers to add, to the extent that there are any data that can speak to the question, would be data, information, or models on house price expectations. Because as we saw in the paper earlier on expectations and house price dynamics, in some sense you must have some story of expectations to explain the consequences of the supply of credit on, you know, booms and crashes and bubbles. And until we have that channel integrated into our story, I'm not sure we will come to any degree of agreement about. I don't think you can answer the question without having a coherent story about expectations and how they are affected by the supply of credit, both at a moment of time and dynamically. I mean, Jelan touched on that at the end, and appropriately didn't say much more about it because there isn't much more to say. But I think that's a very important venue going forward. It's unfortunate that we don't have better data on expectations. But,
It's on. So I think this is all very interesting data, and I liked all the instruments on the payday lending. I was worried about that thinking of it as a causal thing in terms of all the other loans. I mean, presumably there's some shock that happened in people's lives that made them need to borrow, and they would try to borrow on all margins, and they, you know, sometimes could do payday loans and other things, and some, you know, and not always exactly at the same time. The opportunity to do something else could have come up a little later. So I don't think you want to assume the payday loan caused that. On this other thing, contrary to what Jelan was saying, I don't think these things were debated at all, but just painting different sides of the same picture. Like a picture where you have credit expansion to kind of all the income groups fairly equally, where the sense in which you have worse quality is mostly about a higher loan-to-value ratio, not even a ton on the FICO scores, though maybe a little bit on that, but primarily, you know, the same people in terms of income and FICO scores, but higher loan-to-value ratio. That certainly, even mechanically, that gets you more demand, plus making it attractive to some people. That does have an effect on house prices that gives you a multiplier. But on the way down, you have some very specific macroeconomic things, in particular, the way they were packaged and to affect the banks that then are a huge part of the story later on. So I think that paints, I love having all this in one session to paint that combined story, but I don't see any conflict at all between these different pieces of the puzzle. To me, there's at least one totally coherent story that fits all these things. And since I believe the identification in each case, I'd want to look for a story where all of these things were true rather than to talk about it as a debate.
I'll take that first. In terms of the payday loans, I mean, what we're comparing is people who are denied the loans to people who are accepted for the loans. There's some sense in which it's not a completely pure control group. It's not like the people on the left-hand side did nothing and then you have a treatment. But I think we can ascribe all the differences that we see after the fact to that. We're controlling for everything else right at the margin. And you've got sort of local polynomial regressions on both sides. I mean, that is the difference. So, I mean, whether it's purely from the payday loan, whether there's an effect on being denied directly, maybe there are some effects, but I do think what we know is we can say it's causally related to comparing being accepted versus being denied for payday loan.
I'll add, we also see each other as inconsistent and circumscribing a lot of truth into one great whole, if you will. To Chris's earlier point about house price expectations, so data is a big challenge in this, as has been mentioned over and over again. I have a section of the paper that I don't get to even when I have an hour and a half, let alone 20 minutes, but where I do look and say, well, what is it about house price declines that seems to be so effective? And I can put in a measure of fairly well from CoreLogic of your equity position and a very flexible function of how far underwater you are. And even over and above that, recent house price momentum has a big effect. And so I can't say that there's like a missing first stage there that maybe I have to appeal to Charlie's paper for, that is because of expectations. It's also just because of when house prices are falling, no one's showing up to your open house, whether you have positive or negative equity, and so you have a very liquid asset, but there seems to be scope for expectations playing a role here.
Hi, good afternoon. My name is Asantha Chang-Smith, and I actually work for the state of Maryland Housing Department, so I'm very much on the ground on what we're seeing, locally and nationwide. So one area maybe for research I know that we would love to find out about is, we're living with the recession and the foreclosure crisis, and I continuously get asked, when can we see the end of this foreclosure crisis, in a sense, to reach levels before the Great Recession? Or are those levels never going to come back, and are we looking at a new picture?
So I think it's a fantastic question, one that we all think about and yet are not certified as experts by the virtue of the particular papers that we've written today to opine on it. Credit does seem to be pretty tight right now, and there's certainly a worry, as I've talked with policymakers, that what's the right balance here between having accessible credit, which both fuels equity and a price recovery, but also could potentially fuel a future boom and bust in the future. So just looking at the distribution of credit scores of people who are able to get mortgages right now, it's much, much higher in terms of the mean and the distribution than it used to be. So credit seems to be tight. That seems to be inhibiting a recovery. On the other hand, we've seen this rash of defaults that happens in a price cycle when you loosen credit. So there are these trade-offs, and no one seems to have the right balance in mind. I'm not sure that we're at that balance there now. One interesting thing I'm sure that you see on the ground in Maryland is that there's tremendous heterogeneity across space in the recovery. So it's certainly, like Arizona, for example, recovered pretty quickly. Nevada has not recovered almost at all, and we see different things all over the place. And one thing that is very interesting for policy is the fact that foreclosure timelines are so different. So there are some studies that are starting to come out that say, and I have some grad students working on this, that when you have a long, long foreclosure timeline, it can inhibit this kind of recovery. And there's almost something about ripping it off like a Band-Aid, where you can get the market to start to heal. And so there's lots of variation in these policies, and I don't think anyone's really hit one out of the park yet in answering those questions.
Okay, I will turn this over to Chris to give us closing remarks, or Ron.
So Ron and I are up here just to say thank you to everyone that made this conference the tremendous success that we think that it has been. And I particularly would like to thank the CFPB staff, all of whom really stepped up to the plate and did an amazing job in organizing this event. And let me turn it over to Ron.
So I get to thank the honor of everybody else for having submitted their papers, for having participated today, presenting their papers, discussions, questions from the floor. And with that, to officially close our first CFPB Research Conference. So thank you all very, very much. All the best.